Liquidity-driven trades, right? It used to all be liquidity-driven. It was about trying to get execution. So when we're looking at HFTs, the one that we're looking at here is, for example, the statistical arbitrage HFT, right? This is the arbitrages here that we're interested in. Now, obviously, some of these tie in with each other. We get this idea that, when we're looking at statistical arbitrage-driven events, we're also looking at things that become very, very, very high statistical arbitrage. And a lot of that then ties in with the liquidity detection HFTs. So these two HFTs talk to each other, because you might have a statistical arbitrage market neutral trade, which obviously things like volatility versus equities would be a market neutral arbitrage, correct? Effectively, it would be a market neutral arbitrage. So one of the things that we try and understand is that we might see a market neutral arbitrage, but we still might have 5 contracts available to buy into. It doesn't make it a trade. So one of the things that it tries to do is it then tries to sniff out liquidity to make this trade sizable enough to generate a response. Now, when you do that, a lot of the times you give away value. And a lot of times you actually gain value. So this is the two things that we're looking for here. When we look at these as two of the main indicators for this HFT-based strategy, well, that's exactly what this trade does in here, isn't it? It's exactly what happens here. Because the market neutral arbitrage strategy, you can see that this market neutral arbitrage strategy here against the gamma line, we can then look at that and say, well, if that market neutral strategy there against the gamma line is there and it's perfectly visible, what I can now do is I can now look at that and say, well, as an algorithm, what happens? Well, if I take it down to the 15-second chart, you can see that there are several market neutral statistical arbitrage opportunities here based around the liquidity detection algorithms. Do you see that? Because based around liquidity detection, of course, they would obviously look at that and say, well, there's liquidity there. And then they would look at that very same liquidity and say, there's liquidity there. And so long as the market neutral algorithm is still very much in place, they're going to use that liquidity for that statistical market neutral arbitrage trade. And there's the trade. So sometimes they go for the liquidity. So you can see they went for the liquidity here and the value is still valid. And then they lost the value temporarily here and then they regained the value here. Do you see it? And they got liquidity. So they got the liquidity and value there, and they got the liquidity and value there. They're now able to take the two algorithms bid at the same time. And obviously now that they've taken the two algorithms bid at the same time, life can be pretty good for us. We can now sit back and enjoy the ride north. And this is at 15.19. Of course, this is a different trade to that absorption we saw before. You can see that the original trade here was at 15.16 approximately. And when we look at this on the NASDAQ, I know we're looking at the SPY here, but that makes no difference. What happens at 15.16, 15.17? Sellers are getting absorbed. You see that? Sellers are getting absorbed. Who's absorbing those sellers, Marcus? Who is absorbing those sellers? The statistical arbitrage algorithms. The market neutral arbitrage algorithms are absorbing those sellers. And they're taking the market bid from that, aren't they? So they're coming into this, absorbing, and you can see them buying into that liquidity. It's there. You can see it. It even generates this absorption title on that little bit of business. Well, you can lean as a trader against that algorithm you can lean against that absorption as a retail trader at 301. They swept the 300 liquidity because you would imagine 300 liquidity in its own right is going to bring in a fair amount of volumes. They've swept that. You've lent against it, and you've taken your buy right there, 1517, 1517. So you can see this market neutral arbitrage here is very, very clearly visible. You might classify this as cross asset, cross market arbitrage, but I like to just give this one, when you're using these volatilities, I like to just call it market neutral arbitrage, because that's, volatility versus the underlying product to me has a market neutral quality about it. So when we see this as a process, it's exactly the same as that 1507 buy trade as well, isn't it? Look. So the 1507 has massive value. So they need that liquidity to come in, and they get the liquidity right there. So the liquidity detection algorithms, the liquidity detection HFTs are part and parcel of this program here. They need to be. They have to be. Why? Because if I can only get 2 contracts into that deal, it doesn't make me any money. I need to get size on these arbitrages. Otherwise, there's not a lot of value in arbitrage. So sometimes you give away some of your statistical arbitrage, some of your market neutral value to get liquidity. So long as you don't give it all away, you're in good shape, right? So then we come into this and see that this is going to be a market neutral arbitrage event, as was this one as well. You can see the massive volume that arrived at that stage. And you might say, how's that market neutral? Well, look at the value narrative. It's gone up, right? So they ran this liquidity here for that market neutral event, didn't they? They ran that liquidity there. And they took it down to the next liquidity, which was this one here. So they ran basically paycheck liquidity into that storyline. Do you see it? Look at that. It's exactly what they did. And they got the volume that they wanted right there. And you could argue that they got the volume they wanted there as well after that paycheck was taken out there as well, didn't they? Now, what did these algorithms do? What was the clue that it was this one and not any other one? What's the clue that it was this buy trade here, Marcus? What was the clue? I actually did this in class this morning. What was the clue, guys? What does that liquidity detection algorithm actually do? The clue was that generally, as a rule, the liquidity detection comes in from running a situation, running a play, right? So they run a play. So if I'm looking at this buy side value, which we've just discussed is what we were looking for, the algorithm's going to put a play together. And the algorithm's going to put a play together that looks a little bit like this. So they're going to put in a higher high first, right? Remember we had this conversation this morning? They'll put in a higher high before running that play to the downside. And that's how the liquidity detection algorithms can sometimes help you out with these. Because the more buyers you can encourage into here, the more sellers you'll have below there for your buy trade to work. So how did we know it was going to be that trade and none of the other ones? Because they did exactly that algorithm. That exact algorithm kicked off at exactly that point. You see it? So here we never really got any higher high buys. You see that? In this one here, we never had any higher high buys anywhere along that process. You see that? And yet here, we broke that high there. We broke this high here. We got those higher high buys prior to this big buy trade here. And equally, we got that higher high there prior to this buy. Now, you might argue, and rightly so, that we did get that higher high the previous one, and that gave you a nice opportunity to buy in there as well. You're right. So this is part of that algorithmic sweep that they build. It's part of that chaos that they create. It brings in this very small short-term momentum-based algorithms. And you can see that when we look at that short-term momentum-based algorithm, they're based on momentum, right? Higher highs, higher lows. There they are sitting right there. So these statistical arbitrage guys and liquidity detection guys, they trade opposite in a lot of cases, these guys here. Still HFT trading, right? So there's a lot of short-term momentum buy trades come in, and that creates a good condition for us to take advantage of. So this is the momentum algorithm guys coming in at that point. So you can see we get a higher low and then a higher high, and the short-term momentum algorithms are maybe getting involved in this as a trade, right? So they're maybe coming in there, they're maybe coming in here, and then of course their stops are going to be potentially running this liquidity here, and that gives us the opportunity to then buy into that low price right there. And that's what you saw developing in here. Do you see that? So they made it as bloody awkward as they could, didn't they? I mean, look at how much value is in that buy trade, and yet they made it nearly impossible for you to make any money on the buy side by taking it higher and then dropping it fast, and then taking it higher and then dropping it fast. And they did it once, twice, 3 times, 4 times, 5 times they dropped it, 6 times they dropped it before the big rip took place. You see how beautiful that is? You see it? So 6 times they dropped the price to get rid of your buy order and then rip the price higher, or based on that very simple process of algorithmic buying and selling. And when you see that that's what they do, you know what they're going to do. You're waiting for that higher price. So when you're, for example, if I'm looking at this setup here and I'm looking at that and I'm saying that's very good because we've now got buyers again at higher prices. So if I can get any sort of a liquidity detection in here, this is going to be a buy trade, correct? And then when we made another high price here and a little pivot price here, you're thinking to yourself, well, let's do it again. It gets even more exciting because we've now got the chaos that the algorithms have caused. And we've now got the ability to capture that little bit of business there. And they run the sweep because then that captures the spread, doesn't it? So they then use another algorithm here, which is this spread capture. So when we've got the whole setup developing with these short-term momentum guys, then what happens is it loops all the way back round from here through to here, and then back to here. And they capture the spread by pulling away the offers, pulling away the bids, or then stacking the bids and pulling away the offers at that stage. So they create that sweep condition that captures the spread. And they don't provide any offers. So as soon as they capture the spread using the stops, they then stack the bid and they pull away the offer, and that spread is now completely captured inside of that narrative. And that's just what they did. And now I know a lot of this takes place in the micro world that's not visible even on this chart, but if we're looking at it from that bigger view picture, the idea is that this is exactly what they did in and around this trade area. It's the perfect example of what we were talking about this morning, about seeing that buyer at higher prices, opening the door to the sweep. So the momentum algorithm comes in here from the failed auction, pops a bid in here, swept. The momentum algorithm comes in, failed auction, pops a bid, drops the price down, swept. Puts a bid in here, gets their bids popped into stops, swept. And then the market goes bid. and then we make the big play. We make the big money. Make sense?